Welcome, folks. This is Tom O'Brien of TFNN. We go 5 days a week. We go 10 hours a day. We go 24 hours a day on the internet at TFNN.com. Always remember, folks, whatever you think about, you bring about. Whatever you focus on grows. It's a TGIF, folks. And as we do each and every week, I have a man, Mr. Dave White, growling and prowling with us out here. Let's take a look at this quote. Almost everything is more complicated than it seems, but almost nothing is hopeless. I don't get this card, because really, most things aren't that complicated, right?
It depends. Einstein said that if you really understand anything, you can explain it to a 12-year-old.
Okay.
So
right.
if you can't explain it, then you probably don't know it well enough.
Yeah, cool. Yeah, that's the common sense deal, right?
Yeah.
No, I like that. Market-wise, let's take a look at it out here. We had the Dow Industrials down 46, NASDAQ off 12, S&P's down 5.5, gold contract up $1.50 at 1,091 an ounce. Deviations, folks, inside the gold market big time. Jobs number come out, they get it down to 81, rejects lower price, goes topside, well, goes flat, but goes topside. Silver, $14.74 an ounce, platinum up 10 at $9.61 an ounce. Light sweet crude. Man, we're going to have cheap oil, man.
I saw him out there with the ladders today, moving it down by a penny.
By a penny. I love it. I love it. So, folks, the oil market down 81 cents today, 43.82. Now, the thing that's really cool, folks, is this. The low that was established, about 4 months ago was 42. Bottom line, though, the low established in 08 was 35. I think you're going to break it. We'll find out. Bonds, the ever-ready bond market, forget it, man. The 10-year up 14 ticks. That baby's trading at 127.15. 30-year up 1.25 ticks, 158.16. That market, folks, has continued to give the best information that bonds want to go higher, market wants to go lower on a continual basis. Wide price spread, accelerated volume again. King dollar. King dollar couldn't handle the swing point again. King dollar was up 400 ticks, ended up closing down 196 ticks, 97.71. That's about as deviant as you can get. The job market comes out, right? It really is. That is one of the most deviant moves, folks, okay? The job market comes out. It's a fabulous job market, right? They smoke gold on the way down. The market really, the S&Ps didn't react. The euro and the dollar went all over the place, but the reality is that the theory is that if they go up on the rates, that, would have a stronger dollar. But, you've heard what I was saying. I really start thinking, I'm saying to myself, you know what? It seems that they can go up in the Fed fund rate, but that doesn't mean the 10 and the 30 years is going to go higher.
I'm on the opposite side on the dollar.
Oh, I know that. No, I know.
But all I want to do is see whether it tests 100 again, right?
It couldn't,
which is the previous pop.
I know, but couldn't even handle that 98.
And it hadn't moved down either. So neither one of us is happy. That's probably...
I'm happy. No, this is so cool. Because I'm definitely happy because, see, it failed today. Because this had the shot, man. I mean, it had the volume, it had everything on that swing point. It should have been able to take it.
To me, unless it probably closes back below 96.30, I would be at worst agnostic and at best thinking that we're still over that support line.
Well, you and Andy are going to take me out to eat when it goes to 93.30.
96.30. I'll come back and say I was wrong if it closes.
No, listen, man. It's just I find it so intriguing. See, what's really cool right now, folks, is this: you can really learn a lot about markets in a market kind of like this, because technically we can teach you what the technicals mean, but what happens is you got to go through these cycles, man. Do you know what I mean? And that's what's happening with this thing here. It's like, okay, we haven't been through a cycle like this. It's like, okay, so they're going to go up on the Fed funds rate. Well, you and I don't get the Fed funds rate. No one gets it. And you're going to go up from 0 to 25 basis points to what? 25 to 50 basis points. Is that going to move the 10-year? Doesn't look like it's going to move the 10-year, and that means it doesn't move the mortgage market.
Now, the last few days, everybody's been talking about some of the paperwork that's come out of the Fed.
Yeah.
Now, what they've been reading, at least the Fed people, is that even if they move it up by a quarter,
right,
there is so much leverage out there that it's not going to be the equivalent of just moving it up by a quarter, but it's going to be the equivalent of them moving it up to maybe 3/4, because there's going to be a lot of this leverage that has to come back out because everybody's so high already that this money's going to have to start coming back in.
But I don't really understand that, because it's not the aspect of, here, watch this. If we put this up so you can see the yield curve here. So if we take a look at this, and this is where, so the normal theory is that, well, I'll start with the 2-year, okay? So the normal theory, folks, is this, is that if the Fed funds rate goes up, you know, the 2-year yield is 0.72 of 1%, okay? So if the normal bank-to-bank rate goes up by 25 basis points, it's supposed to send the whole yield curve up, but it's not happening, okay? And I've seen this not happen one other time, okay?
The argument, I probably didn't make it plain. The argument is more of a structural issue, where like the Black-Scholes and all those things are based on the current interest rate.
Yes.
That everybody is so leveraged out that those kind of automatic systems for defining risk, since their risk is zero now because the interest rates are basically zero, that moving them up would get a lot of people that are kind of in a bubble already to go ahead and move, so that it would feel more like they went to 0.75%. At least that's the opposite of the argument. We don't know because no one's ever tried it.
No, we're going to see. You know, we're going to see, you know, because the 2 years at 0.7 right now. The 5-year is at 1.5, and the 10-year, and the 10-year is what you really care about, folks. The 10-year has to do with our mortgages, is 2.1. The 10-year is going to go under 2 again.
Now, the Bank of England came out yesterday. For 20 straight quarters, they said that they're going to be raising interest rates.
Yeah.
Now it's 21 straight quarters that they're going to say that they're raising interest rates. And the question is, I know you're on the side that you don't think that they will, or have you changed kind of that?
No. Well, after this jobs number this morning, they should.
Right. I mean,
but what's still happening, the market is still saying, well, this is what happened. I'm saying, you know, even the last 3 or 4 days, I'm saying to myself, okay, man, they don't have to raise the rates, okay, but it looks like they're going to. And then I'm watching the dollar. Of course, we're all in the metals market, so we're watching the dollar. The bond has been the best indication of what's happening. To me, the bond has, for 2 years now, has been continually saying, guess what? You know, these markets are tough. They're probably going to come down. And, you know, so technically it's telling me they want to go higher. Fundamentally, it's a no-brainer. Fundamentally, why would you give money to Spain or Italy? I left this lay in Italy in the Amalfi Coast for a good 6 months, but the bottom line is that our rates are twice theirs.
You want to look like you're making money now.
Dave White, Tom O'Brien, you stay right there, folks. We're coming right back.